Hello, everyone. You are welcome to today's episode of Accounting Focus. This is powered by Ayuba Kodri Olayemi. In today's episode, we will discuss how a template can be developed for marginal costing technique. That is, when we want to prepare income statement under the marginal costing technique, what is the template we will use? Before the explanation is given on the template, or before it is demonstrated, what do we mean by marginal costing technique? Marginal costing technique is a technique that distinguishes between variable cost and fixed cost. Marginal costing technique is a technique that distinguishes between variable cost and fixed cost. Marginal costing is also an alternative method of costing to absorption costing. Marginal costing is also an alternative method of costing to absorption costing. And in marginal costing, all variable costs are charged as cost of sales. All variable costs are charged as cost of sales. In marginal costing as well, costs are classified according to the behavior. Costs are classified according to the behavior. What do I mean by that? All variable costs will be grouped together, while all sales costs will also be grouped together. All the variable costs will be grouped together, while all the fixed costs will also be grouped together. That is under marginal costing. Now, these are examples of variable costs. The first one, direct materials. The second one, direct labor. The third one, direct expenses. These direct costs, when they are added together, we call them what? Prime costs. So the addition of the direct costs is prime cost. It should be noted that all direct costs are variable costs. All direct costs are variable costs. Also, other variable costs are, number 4, variable production overhead, variable selling and distribution overhead, and variable administrative overhead. So these are 6 examples of variable costs. And these are the 6 costs that will be grouped together under marginal costing. These are the 6 costs that will be grouped together under marginal costing. So in marginal costing, fixed costs are treated as a period cost and are charged in full to the income statement of the accounting period in which they are incurred. Fixed costs are treated as a period cost and are charged in full to the income statement of the accounting period in which they are incurred. So that is why under marginal costing, fixed cost is always referred to as a period cost, for the fact that the entire fixed cost will be deducted from contribution. In marginal costing, how do we prepare income statement? How do we prepare income statement? And that is the template we made that we are going to develop. But before we can see how the template will be dealt with, the next thing is now to look at what we mean by contribution. How do we calculate that contribution? Now, contribution is of fundamental importance. It is of fundamental importance in marginal costing. And the term contribution is really short for contribution towards covering fixed overheads and making a profit or loss. Contribution is really short for contribution towards recovery of fixed overhead and making profit or sustaining loss. So under marginal costing as a technique, to arrive at contribution, it is just a deduction of all the variable costs that have been grouped together from sales. Sales, we remove all the variable costs, and the end result is contribution. And when we have got this contribution, we have explained that under this marginal costing, fixed cost is going to be treated as a period cost. Therefore, fixed cost will be deducted from contribution to arrive at either profit or loss, where the contribution is higher than the fixed cost, we will be having profit. But a situation whereby the fixed cost is more than the contribution, that means the operating result is a loss. The operating result is a loss. Also, we can calculate total contribution. Total contribution is contribution per unit. Contribution per unit multiplied by sales volume. Contribution per unit multiplied by sales volume. Contribution per unit multiplied by sales volume. Let us now see how a template can be developed for income statement under marginal costing. Let us see how a template can be developed for income statement under marginal costing. Now, in the template, we may disregard inventories in the calculation. We may decide to show inventory. But regardless of whether we show inventory or we ignore inventories in our calculation, sales value is always equal to quantity sold multiplied by selling price per unit. Sales value is equal to quantity sold multiplied by selling price per unit under the two. However, However, if we want to determine our variable cost of goods sold, here, calculation should be based. Calculation should be based on quantity sold. Calculation should be based on quantity sold, where we have decided to disregard inventories in the template. Here as well, when we are trying to calculate variable cost of goods sold, so far we will show inventories in the template. So far inventories will be shown in the template. Definitely, our calculation here, calculation should be based on quantity produced. Calculation should be based on quantities of production. So we must ensure that we follow this rule. Once more, we may decide to show inventories in the template. Where we show inventories in the template, to calculate variable cost of goods sold, we will make use of quantities that are produced. Quantities that are produced. But in a situation whereby we have decided to ignore inventories in the template, our calculation should be based on quantity sold. This is important rule that we must follow when we are developing template for income statement under marginal costing technique. Let us now see how the template can be developed. We will look at the two situations. The first situation, a situation whereby we decide to ignore inventories in the template. We decide to ignore inventories in the template. We will not use opening inventories in our calculation, and we will not use closing inventory. Now, income statement. Marginal costing technique. So here, we want to ignore inventories in the calculation. That is, we will not show both opening inventories and closing inventories, even if they are given in the question. So this is how the template will look like. We have sales. Our sales will be quantity sold multiplied by selling price per unit. And we deduct total variable cost from quantity sold. We deduct total variable cost from quantity to sold, because we have already said that under marginal costing, all variable costs will be deducted from sales to arrive at contribution. And that is exactly what we are trying to achieve. But here, so far we are disregarding our inventories. There will be no opening inventory and there will be no closing inventory. So what we are going to have is this. We will have direct material. We have direct labor, direct expenses, provided we have it in the question. So variable production overhead, variable selling and distribution overhead, and what? Variable admin overhead. So these are the 6 variable costs. But in arriving at the value or the amount we will make use here, all these, they will be based on what? Quantity sold. They will be based on quantity sold. That is, what do we mean by that? What we mean by that is that to arrive at this direct material, we will use quantity sold multiplied by direct material cost per unit. Labor quantity sold multiplied by labor cost per unit. Direct expenses, if any, quantity sold multiplied by what? Multiplied by direct expenses per unit. Variable production overhead, that will still be quantity sold multiplied by variable production overhead per unit. Now, in the question, we might be told that variable selling expenses is going to be based on certain percentage of sales. Variable selling expenses will be based on certain percentage of sales. So we work in line with the requirements of the question. We work in line with the requirement of, alternatively, we may be given variable selling expenses per unit. So whether it is given in percentage or it is given per unit, there we could still express it in what? In unit. So what I'm saying in essence here is that to arrive at all this, our quantity sold will always be multiplied by what? Cost per what? Per unit, to arrive at all this. So we will now add all this together and deduct it from what? From sales, to arrive at what? Contribution. So what we have just done here is that we have grouped all costs together, those costs that are variable, and we have deducted all those variable costs from sales to arrive at what? Contribution. So after we have got our contribution, the next thing is now to group all the fixed costs together. Now, fixed costs will be grouped together. Now, the first fixed cost here, we have what? Fixed production overhead, fixed selling and distribution overhead, and fixed administration overhead. So these 3 fixed overhead will be added together. And that is why it is stated that under marginal costing, all fixed costs will be treated as period. So whatever we are given as the budgeted fixed overhead for this 3, those are what we are going to deduct from contribution to arrive at what? Net profit or loss. So this is how we develop templates for marginal costing technique. But in this template, we have disregarded inventory in our calculation. And to emphasize it again, anytime we disregard inventory in the calculation, To arrive at the cost of sales, variable cost of sales here, all the calculation must be based on quantity sold. Calculation must be based on what? Quantity sold. And that is when we will be able to arrive at the true contribution. So the next thing is to consider the development of income statement when we decide to show inventories in the template. That is a situation whereby we want to show both opening inventories and closing inventories in the calculation or in the development of what? Of the template. Let us see how that template is going to look like. Now, we have income statement. Using marginal costing technique. And here, we want to show what? Inventories. Inventories are recognized here. Here, inventories are recognized. So let us see how this template is going to look like. Now we have sales. Sales value does not change regardless of whether we show inventory or we disregard inventory in the calculation. Our sales value will still be quantity sold multiplied by selling price per unit in a particular period. Now here we have variable cost. How are we going to arrive at our variable cost here? The first thing is to calculate variable production cost. The first thing is to calculate variable production cost. And to do that, so far we have decided to make use of inventory here, so we will have our what? Opening inventory. This opening inventory will be what? Quantity of that opening inventory multiplied by variable production cost per unit, followed by direct material, direct labor, direct expenses, if any, and variable production overhead. Now, all these that we have here, they will be based on what? Quantity produced. They will be based on quantity produced. Why they are going to be based on quantity produced is that we have decided to make use of what? Inventory in our calculation. We've decided to use what? Inventory in our calculation. Where we disregard inventory, we should base the calculation on what? On quantity. But so far we have decided to show inventory here. Definitely our calculation here is going to be based on what? On quantity produced. So what we are now saying in essence is that the quantity produced multiplied by direct material cost per unit, that will give us what? Direct material cost here. Quantity produced multiplied by direct labor cost per unit, that will give us what? Labor cost here. Quantity produced multiplied by direct expenses per unit, that will give us what? Direct expenses. Variable production overhead per unit multiplied by quantity produced, that will give us this as well. Now, all these 5 costs will now be added together. When we add all these 5 together, we are arriving at what? Total variable production cost of goods available total variable production cost of goods available. So this is the total variable production cost of goods available. And it is from this one that we will now remove closing inventory. We remove closing inventories. So when we remove closing inventories from this one, we arrive at variable costs of goods sold. And to determine this closing inventory here is a mere saying that the unit of the quantity of closing inventory multiplied by variable production cost per unit. So we are now having variable cost of goods sold here. So the difference between the first template and this other template is that under the first template, we don't have this closing inventory here, and we don't have opening inventory there. But in this one, we have opening inventory and we have closing inventory. So that is the mere reason why we have used the quantity produced here. In the other one, we will not use quantity produced again, but we are going to make use of what? Quantity sold. Now, after we have now arrived at variable cost of goods sold here, this is just variable cost of goods sold. We are having other variable costs that we still need to be recognized. And we are now talking of, that's when we can now recognize variable selling and distribution overhead. Overhead, variable administrative overhead. So these two will now be added to variable cost of goods sold, and we extend it here as a deduction to arrive at contribution. So when we have now arrived at contribution, the process still remains the same. The next thing is now to deduct our fixed overhead. Now, our fixed overhead here, we are talking of what? Fixed production overhead, fixed selling and distribution overhead, and what? Fixed administrative overhead. So all these fixed overhead will be added together, and we deduct them from what? From contribution to arrive at what? Net profit or loss. Now, the result we will be having here when we make use of inventory will be the same result we are going to be having where we disregard inventory. Note this again. When we have used when opening and closing inventories have been used in the template, quantity of production must be used for the purpose of calculating cost of goods sold. I mean what? Variable cost of goods sold. So that is exactly what we are going to do. So the last thing to look at under the development of this template is to consider how inventory is valued under marginal costing. To consider how inventory is valued under marginal costing. Now, under marginal costing, inventory is valued at variable production cost. Inventory is valued at variable production cost. So to determine this value of inventory here is a matter of just adding the first 4 costs together. And what are those first costs? We are talking of those costs that are meant for production. So to determine the value of the inventory under marginal costing, direct material, direct labor, direct expenses, variable production overhead. All these 4 costs will be added. They are going to be added together to arrive at what? The value of inventory under what? Under marginal costing. So this value of the inventory we are talking of, per unit of it, is what we need to use to multiply the cost of and the quantity of what? Both the opening inventory and what? And closing inventory. To multiply the quantity of what? Both the opening inventory and closing inventory to arrive at the value of the opening inventory and what? Value of the closing inventory. Note again, under marginal costing, inventories are valued at variable production cost. So to round off, it should be noted that the template we decide to use is going to dictate the approach we are going to adopt in preparing the income statement under marginal costing. Where we have decided to ignore inventories, our calculation should be based on quantity sold. Where we have decided to use what? Inventories in the template, our computation is going to be based on quantity produced. Ladies and gentlemen, this is how a template can be developed for the preparation of what? Of income statement in what? Marginal costing. So if you find this presentation to be educative, kindly subscribe to my YouTube channel. Also inform your friends to do so as to get any notification when I upload any video on any aspect of accounting. Thank you and have a wonderful moment.